Hello, everyone, and welcome to Core Training. And this is the execution portion of Core Training, which deals with risk management. Risk management is one of those things that is vital for any trader to succeed in any market environment. And if there is any holy grail to trading, I firmly believe it's in executing the proper risk management approach. And so that in and of itself, risk management can be one of the most important facets of your game that you develop and improve over time. And we're going to look at some various approaches to thinking about risk and also how to identify and then build strategies for or think about creating strategies for mitigating and managing that risk. So risk management is the process of assessing risk and then developing strategies to manage that risk. And we must be proactive about measuring, reducing, and preventing risk. So this right here basically says it all. Risk management is kind of two facets to risk management. Basically the assessing the risk portion and then the developing of the strategies to manage that risk. I think a lot of times in terms of trading, novice traders start out with just thinking about, hey, I gotta have a stop. That's the basic form of risk management that you kind of come across. But over time, as you become more seasoned, you know that there are so many more varieties of risk, and you know that there are many ways that you have to kind of counteract those risks that you encounter on any given day, because there are so many different types of risks. It's not just the risk that you put on the line in terms of a stop. It's not just that types of risk. There's so many other different types of risk as well. But when you do finally develop an approach, a full-on risk management approach, including a lot of great trade management techniques, like our scaling techniques, which we'll be learning about more in our core trade management portion. Really, the big deal here is that the primary goal of any trader is always to manage risk first and foremost. That's the primary goal for every single trader. So failing to understand risk or failing to create a plan to mitigate and manage risk will doom you as a trader. And usually I don't like to talk in terms of negatives, but really this is how important risk management is. Because again, you can see that for some traders that have high risk tolerances, they'll make a whole lot of money because they allow their risk to be much more exposed and open. But then that also means that when they lose money, they lose big as well. So the primary goal with regards to the way I approach the market, and I like to teach it, is for the most part, you have to manage your risk and be proactive about managing that risk throughout the life cycle of a trade, or even throughout the life cycle of just engaging a market. You have to constantly build some sort of approach or strategy to manage your risk, and then you have to continue to assess whether those controls that you're putting on there are working. And so it's always becomes kind of a refinement approach with regards to trading the market. Number two here on the list, you can see that mastering risk management improves your odds for success. From anything that I see, that I've done over time, any one little concept that you can apply to your trading, proper risk management is the one single thing that you can control right now, and it will single-handedly improve your trading. That's how important risk management is. And so mastering risk management here, it says it improves your odds for success. And it's merely your discipline in executing your risk management plan. It's merely that discipline which will determine your success as a trader. So if you're a disciplined trader and you execute your plan, then you're more likely to have success. If you do not follow your plan to a T, and you're kind of reckless and your execution has issues, then you're going to have much more of an uphill climb as a trader. And I always say this, trading is difficult enough as it is. So when you can control certain parts of trading, like trade management, it's best to really control them all the way as much as possible, and limit variables there and other things, because everything else is always so fluid and ever changing, but your risk management can always be predetermined ahead of time. Risk management is the easiest part of your trading plan to implement. It's so funny because when traders engage the market, the first thing that falls apart is after a couple of losing trades, they don't want to lose more. So that third trade, they don't adhere to their stop. So they pull their stop and they're like, you know what, I gotta hold on until this is a winner or whatever the case is, and then that leads to ruin. You know those days, right? Well, it's funny because those days we all know that's what leads to a bad day, but in reality, risk management should be the easiest portion of your trading plan to implement because it's already predetermined what you will do. The risk management is already built in. It's already preconceived. You've already said, this is how I am going to enter a trade. This is how and where I will scale. I will then scale again if this happens. I will add back if this happens. There's no guesswork. You just execute the plan. That's why you create a plan the way you do, because you're supposed to just follow the plan. And what that does is it eliminates, the emotion from trading. It helps to remove that emotion from trading because so much of the time, there's scars. There's scars from a lot of traders from trading earlier in their careers where they lose a lot of money because they're not obviously adhering to some of these principles. And then from there, it's hard to execute and pull the trigger. Because now you get gun shy. Now you're thinking, man, I don't want to lose money again. What if I don't take? And then, of course, that's the trade that makes money. So then you're like, well, now I got to force it. And now you get into trouble because now you're forcing trades and it just becomes a revolving wheel type of scenario. But in reality, execution should be the easiest portion of your trade. And so that's why I teach so many different leading indicators the way I do, leading prices and leading edge analysis, because this type of analysis allows traders, no matter your time frame, it allows traders to plan for their trades, plan ahead of time. I know ahead of time there's an inside value or a higher value. I know ahead of time that there's, prices holding above this LVN, and whatever the case may be, there's a plan in place. So being able to just execute a plan right there is always so much better in terms of trying to achieve that consistent profitability, or at least a consistency in your trading approach. Implementing a proper risk management plan or approach leads to consistency, and that's super important because consistency and consistently managing risk leads to smaller losses, and that again also helps to lead to increased profits and also improves your mindset and trader well-being. So there's a lot to be said about consistently managing trades the right way, consistent risk management, because you can't really say that about other parts of your game. If you say, I consistently enter the market so well, that's something, you can brag about a little bit, but at the same time, it's not going to make or break your day all the time. It's the trade management aspect. That's where your days really fall apart. That's where the days where, hey, I've got 5 losses in a row, I got to dig myself out, so you get another 5 losses in a row. And it's that failing to adhere to some sort of risk plan that cuts you off from trading after a certain amount of losses, or limits your trading after a certain X amount of your account has been taken away by the market. Failing to mitigate that risk in some way and attack those ways that you can lose money can cost you so much money, really. So by basically adhering to a consistent plan and basically executing it with consistency, it does so many good things for you. It's almost like exercising. We all know exercising is great for you, right? But how many folks really exercise, especially depending upon your age bracket, right? There's so many different things going on at different parts of your life, it's hard to exercise. But we all know exercise brings about great health and great well-being. It makes you happier. There's so many great benefits to it. But on the downside is, if you do not exercise, then there's also very bad side effects, right? You become unhealthy, you get sick, and this and that. It's the same thing with risk management. It's almost like exercise. Everyone knows you're supposed to do it, and if you do it well, you're going to get great results. But not everybody does it for some reason. It comes down to discipline. With risk management, it has to come down to discipline and a want to. You have to want to be a disciplined trader that keeps an eye on risk and manages their risk and assesses risk in the right way. And lastly here, number 5, consistency allows for better trade development. And so implementing a consistent trade management plan allows you to analyze and measure the validity of your entry and exit ideas. And this is something that really helped me early on, again, because of my background in developing algos, developing those programs that execute on the market. Now, one thing that helped me identify whether one signal was better than another signal, or one key level was better than another key level, or one input was better than another, was the ability to basically identify this risk management approach and then another risk management approach and another one, keeping them consistent, and then saying, I know that this approach should yield X amount of reward. I know this approach should reveal X amount of edge. And then from there, you can attach those several different styles of trade management to that one signal or that one input or that one pivot and see what the results are. And so that consistency allows you to measure signal to signal or tool to tool or input to input. And so again, even when you're looking at your trade journal, for example, just having a consistent approach allows you to say, you know what, when I trade this certain setup with this certain trade management approach, the results are always amazing. So you go to whatever's producing you the money. If those results are amazing right now, you put assets to what's producing, right? On the flip side, if you see in your trade journal that this certain setup performs horribly when you use this certain trade management approach, then you got to dump that, put it on the sideline, and let it go paper for a while and see if it can, if it shakes itself out, because maybe the market personality has changed and now you got to dump it. So that's what I mean about risk management. It's not always just, I get into a trade at this entry level, this is my stop, so that's my risk. The difference is my risk times the number of contracts or shares, right? That's not just that all the time. It's also understanding, when to stop trading, when to add to the trade, when to defend a trade, and those types of things. There's external risk, which we'll look at later on. There's so many different types of risk. So, I think Paul Tudor Jones said it best and plainly here. The most important rule of trading is to play great defense, not great offense, or great defense, not great offense. And that is so true. And that's what I really saw the biggest return in my game. Remember, I always talk about those aha moments. One of the first major aha moments was when I finally said, you know what, I'm going to stop managing my trades willy-nilly. Hey, I'm going to use this stop this time. I'm going to use that, trailing profit this time. I'm going to use a profit target this time. When I stopped doing that and went to a mechanical approach to trade management, a 211, a 111, the 11 technique, a 21, using variations of those techniques, that's when the biggest jump, from one level of my trading went to the next. And remember, I always talk about as soon as I implemented that approach, I went 3 straight weeks without a losing trade right away. Like when you see that how important and how big those benefits are from some phase of your game that you're improving here, like a risk management, you got to continue to put assets to developing and refining that part of your game, because it really does produce a lot. So for risk management, it's basically the process of measuring and assessing risk and then developing strategies to manage that risk. So you always have to be proactive about measuring, reducing, and preventing that risk. So risk management is the process of assessing risk and developing strategies to manage risk. 2 different categories. And knowing the general process for each category is very important, right? And so right here what you see is risk and risk management process. So these 2 right here are very important. This is kind of the process that you would follow here. And so with regards to risk, right, when we're taking on risk, what we're doing really is saying, okay, how am I going to manage this risk? Am I going to accept it and assume that risk? Am I going to avoid that risk somehow? Do I transfer that risk? Or what are some options that I can do to reduce or offset that risk, right? So these are all the various ways that you can deal with risk. So when you're looking at it, there's 4 major approaches to dealing with risk. Accepting it. So for example, if I enter at this price and I have a stop loss, I can accept the risk by, if the stop is hit, I'm out and done. You can avoid the risk by saying, hey, I'm not going to take that trade because it doesn't line up with what I'm doing. I'm not going to risk my money right now on that opportunity. Or maybe you say, I'm not going to trade during lunchtime trading. I'm going to avoid the risk there because it's lack of volatility and it's a lot of whipsaw. So you can avoid it. You can transfer the risk. Maybe you're in a trade and you can see that imbalances are stacking up against you. And instead of taking on the risk of that trade at that point because the imbalances point the other direction, you can transfer that risk by exiting the trade, right? And by exiting the trade, it's a zero-sum game, so somebody else is assuming that risk now. So you can just get out. Or you can reduce and offset the risk in various ways. And this is a lot of what we'll be dealing with regards to trade management, advanced trade management, and those types of techniques is reducing and offsetting that risk. So reducing would be some way of scaling out of your trades. So scaling out of positions using a 211 scaling technique, for example. And so what that is designed to do is as soon as you get into a trade and price goes in your favor, you scale, and then that reduces your exposure, that it reduces your risk exposure right there by scaling because you're taking some right off the top, off the first move. You can also offset risk, for example, by using counter trading vehicles. So if you have correlated assets like an ES and an NQ, well, not so much right now, but similar correlated assets. If you're swing long the NQ, when price starts to go against you, you can short the ES. Those types of offsetting approaches. So there's so many different ways, but I wanted you to understand that when it comes to risk, there are just a few different ways that you can deal with it, and from there you can create processes to deal with that risk and see how those work out in your favor. And if they do, you can keep them in your rotation. If they don't, you toss them and continue to refine the process. So with regards to risk management process, this is how we deal with risk. This is how we identify risk, assess risk, control it, and then review our controls. So again, Paul Tudor Jones says risk is the most important thing in trading. Risk control, right? Risk control is the most important thing in trading. So you have to identify the risk. What are the risks? And again, this is what I mentioned before so many times, especially when it comes to novice traders. The risk right away is just, this is my entry, that's my stop loss, so that's my risk, is that distance. But really, there are so many different types of risk, so you have to ask yourself questions like, what can happen? What can happen? How can it happen? What is causing you to lose money? And so I say that anything causing you to lose money is a potential risk. Whatever it may be is a potential risk. And if it's causing you to lose money and it's a potential risk, then you must counter that thing with a strategy to manage that risk so that you stop the bleeding, right? That's the biggest thing when it comes to risk management. Identify the risk and the causes, and after that, counter it with a strategy to offset or manage that risk. And it can be anything. Like I said, I'm trying to get your mind around not just the trades. It can be anything. Like, for example, I remember I was in the trading room before, and we're trading, and I have my feet kicked up on the table on the trading desk, and I'm sitting back in my chair with my feet propped up. I'm trading awesome. I mean, man, I'm killing it. I'm nailing every single move, and so I had my feet propped up, and I had my hand on the mouse, and I'm like, yeah, this is good, And then all of a sudden, my feet fall off of the desk. My hand slaps the mouse, and boom, it executes an off order, and now all of a sudden I'm in crisis management mode because I got too dang comfortable. Too comfortable, too cocky trading, making money, and all of a sudden I hit a random order, exits me a trade, and then gets me into something different, some type of thing like that. That's a risk. And it's funny because I would always think, man, that's just a one-off thing. It doesn't happen that often. But in my trading career, I can tell you, there have been many, many times that has happened. Similar events like that have happened that have cost me money. I always talk about that time where a developer comes to my machine and grabs the mouse from me and said, hey, what does that button do? And it takes me out of all of my energy trades costing me about 20, 25 grand. It's those types of things that happen, and those are real risks because they cost you money. And so it's not just the risk of getting into a trade and hitting your stop. It's everything involved. It's having a wireless mouse like I do here, and running out of batteries when the market's stacked against you and you're in a trade. So now I have 40 batteries right here, and I'm in and out in a second. I also have a wire if I need to and pop it in. So there's a lot of different forms of risk, and again, it's just dealing with those particular issues. For example, here the risk categories. There's in-trade risk. Your initial risk, right when you get into a trade, there's always your initial risk. That initial risk is always going to be the max you're willing to risk for that particular trade. But there's also in-trade risk, like trader risk, like me accidentally, knocking my feet off the desk and then slapping a trade. There's trader risk in you not executing your trading plan. So if you're supposed to exit at this stop, but you don't want to take your fifth loss in a row, and you say, you know what, I'm not going to execute that stop, that's trader risk, right? So there's a whole lot of different types of risk. And so what I've done, again, I'm very fond of Evernote. Every time I encounter a risk like that that's costing me money, I write it down in Evernote in my little risk notepad. And then from there, I type out some different options to mitigate that risk, offset it, create a new habit so I don't encounter it again. And so that's really what it's all about. It's identifying options for mitigating certain risk scenarios, selecting the best response, and then implementing that strategy. That's really what it boils down to. Technical risks like internet, software, mouse batteries, that was one of the biggest risks that I always encountered, especially coming from an institutional trading background and trading with for a software company where we made platforms for traders, because oftentimes I was the guinea pig trader trading based off of software that was, its first implementation, it's a first build. It's, hey, we just built this brand new tool, here, try it out for us. And so a lot of times there was a lot of technical risk where even though I knew where to get in, I knew this was it, my signal says long, something messes up on the back end. So there's so many different types of risk. Headline risk, walking your dog risk. Walking the dog risk was something that I always encountered also. Walking away from the market, to take a quick break, and when you come back, something's happened. Either because it was a missed opportunity that you've been waiting for, or because, the opportunity you were in went against you. So again, it's mostly about identifying those things that happen throughout your day, jotting them down. Anytime you lose money, whatever causes you to lose money, think about it. And it was always said it's hard to do. It's hard to kind of stand back from yourself and see what you do because you're doing what you do. But if you could just stand back and walk to the corner of your room and visualize yourself sitting there at the desk and trading away, what would you see? What would you observe if you were not you and watching? And, I went back to sitting there and even going as far as recording my screen while I'm trading to see what I'm doing when I'm not finding that trade, or when I'm losing on this trade. Or what did I see really well at that time, to really find that trade. So I've gone as far as recording my screen during the day to see where my mouse is clicking and what I'm looking at if I miss an opportunity. What was my eyes looking at? And a lot of times it was me reading headlines. Headlines. Hey, I'm scanning to the side looking for headlines, but I'm not looking over here. So it's, hey, I got to stop scanning headlines during the trading day sometimes, those types of things. So you find out what, at the nitty gritty, what's causing a risk, and then looking to negate it in some way. So, some of these scanning headlines, absolutely. So some of these are very simple. You just find little ways, like using a predetermined trade management technique or approach. That's a way to offset risk, right? So our 211, 111, those types of things. Cutting your size when trading poorly. Cutting your size when trading poorly, that's another way to offset, when you're trading bad. If you're not trading well, you cut your size. I always tell you that after I trade really well, I always see a big drop in the equity curve because I get too cocky and I start ramping up size. So I've started doing the opposite of that, right? And those are one of those things that I you know, basically assessed and said, hey, something's happening every time I make a bunch of money. Inevitably, I see a correction in the week or two that follows. I need to figure out what's happening, and I need to, manage that. And so that's where that comes from. Just simply, hey, I got chopped up during lunchtime, so I'm gonna stop trading that. That's one of those things that you just develop over time. Sometimes lunch is great, but for the most part, if it's holiday trading or coming into news and things like that, it's mostly going to be chopped. So you can avoid those times if you're not an expert at trading them. So there's so many different ways. I think the biggest one is execution, though. When it comes to execution, it's automating entry and exit executions. This is one where I've seen both sides of it, where I was doing everything by hand manually, and I saw how many times I would fat finger things and mess things up. And then I went to automation, and it was so amazing. And it was another one of those aha moments where my trading just went through the roof, in terms of one of those things that just helps so much more than before. And then I went away from automation and saw how my trading immediately dropped in production because, again, executions or failed executions or fat fingered entries. So I've seen it go. It's one of those things where if you just automate an entry and exit execution, it's so much better. And automation doesn't have to mean creating some sort of strategy. It's easy now. It's so many of these, Market Delta has automation. Stage 5 has automation. IB has automation. Where if you say, get me into that trade, it knows right away the size that you already want. It knows, the stops. It says, hey, your first target is 10 ticks up. Your second target is 20 ticks up. Your third target is 30 ticks up. Your stop is 10 ticks down. As soon as you hit your first target, it's going to sell a third, and do that, right? Adam, absolutely. So once you're doing that, it really, really helps negate that risk that happens with fat fingering things. And again, this is all speaking from experience, and everyone has their own experiences. I know that I lost a lot of money because of executions and because of having willy-nilly trade management, so I went in and really looked at fixing those. I used to lose money because I forced trades during lunchtime when there was nothing there to trade, so I stopped doing that. There's so many things that you just start doing over time, but it's just building an approach that works for you and tailored, to the risk you encounter on a day-to-day. So that pretty much does it for risk management. That's a nice, short and sweet section here for core training, the execution portion of core training. Risk management is super, super important. And again, this was just a quick introduction to risk management to show you the various ways that you should be thinking about risk. It's not always just hitting your stop loss. There's so many different facets involved. And once you can assess risk and identify and evaluate that risk, you can then fine-tune and look for options or strategies to help you offset and mitigate that risk. And I think with regards to trading, everything is about risk management. So many professional traders that I encounter on a day-to-day at times call themselves professional risk managers because that's what you're doing. You're managing risk at all times. And when you kind of incorporate that thought process throughout the spectrum of what it takes to be a trader, from analysis to execution to every other portion in between, I think it really, really helps you with regards to improving those details that really matter. So risk management is one of those fantastic portions that I like to think about all the time because if it's one thing I know, it's constant refinement of your techniques and improvement. Michael Jordan didn't get to where he was because he wasn't constantly improving his game. Always improving your game, and risk management is one of those facets that just produces immediate results. And when you constantly improve your risk management, I think it just leads to constant improvement in your trading results.